Imagine unlocking your phone tomorrow morning and discovering that 20% of your entire life savings has vanished into thin air. Every major media headline is screaming that a deeper, more brutal economic collapse is rushing directly toward your household. Today, you will learn the behavioral mechanics behind why market panics destroy household wealth, who this trap targets, and how to build a mechanical shield around your portfolio. This audit is designed specifically for retirement savers, W 2 employees, and everyday index fund investors. Here is the roadmap. First, we will break down the biological loss aversion trap that forces smart people to liquidate assets at the worst possible moment. Second, we will expose the portfolio freeze mechanism that stops wealth accumulation right when assets go on sale. Third, we will deploy 5 operational rules designed to replace willpower with automated discipline. Most people think market downturns destroy wealth. The truth is different. The permanent damage is caused by the terrified version of yourself that takes control during the crisis. Let us start with a simple baseline. Assume an ordinary employee has $100,000 invested across diversified low-cost index funds. Then, a sudden global economic shock causes the market to fall 20% in a single week. The account balance drops from $100,000 to $80,000 almost instantly. Most investors see catastrophe, but the math tells a different story. Understanding this distinction is the foundation for surviving every future market panic. At this moment, no real wealth has actually disappeared. The investor still owns exactly the same number of index fund shares as 7 days earlier. The drop is a paper valuation driven by temporary market pricing and public fear. But the brain does not interpret the event as a temporary fluctuation. Instead, it experiences the decline as an immediate personal threat. This disconnect between financial reality and emotional perception is where the destruction process begins. Academic research shows that people feel the pain of losing money roughly twice as intensely as the pleasure of gaining it. This behavioral flaw is called loss aversion. To your survival instincts, watching $20,000 disappear triggers the same alarm systems designed to protect food, shelter, and safety. The brain demands immediate action to stop the discomfort. Unfortunately, the action that feels safest is often the exact decision that causes permanent financial damage. Imagine giving in to that pressure and selling the portfolio. The $80,000 moves into cash. The moment the trade executes, the temporary paper decline transforms into a permanent $20,000 loss. What was once a fluctuating market value is now locked into reality. The emotional relief feels immediate, but the financial consequences are enormous. The investor traded future recovery potential for short-term psychological comfort. Now, consider the recovery challenge. To climb from $80,000 back to $100,000, the portfolio must grow by 25%. That is a much larger hurdle than most people realize. Your money must work dramatically harder simply because you wanted the emotional pain to stop. Meanwhile, history shows that markets eventually recover, but now you are sitting entirely in cash while that recovery begins. Selling creates a second emotional challenge. You now have to decide when to buy back in. Most investors avoid re-entering while markets still feel dangerous. They wait until conditions look safe again. Unfortunately, by the time safety returns, prices have often recovered substantially. Investors end up buying the same assets back at higher prices than where they sold them. The downturn did not destroy the capital. Their behavior did. The portfolio did not fail. The behavioral operating system failed the portfolio. This distinction matters because it changes the entire solution. Market crashes are unavoidable. Human fear is unavoidable. But the systems surrounding your decisions can be designed to prevent catastrophic reactions. To fix the problem, we first need to understand why panic feels so logical in the moment. Human beings evolved in environments where immediate reaction was critical for survival. If our ancestors heard danger in the bushes, hesitation could be fatal. The people who survived were often the ones who ran first and analyzed later. Modern markets activate these same ancient instincts. Unfortunately, what protected survival thousands of years ago can destroy wealth today. During a market decline, phones, televisions, and social media platforms flood your environment with negative information. Red numbers, alarming forecasts, and sensational headlines create the impression of an immediate existential threat. The brain interprets these signals exactly as it was designed to. The problem is that modern financial markets require behavior that is completely opposite to ancient survival instincts. In nature, running away often solved the problem. In investing, running away permanently interrupts compounding. Investors convince themselves they are being responsible by selling or pausing contributions. They believe they are protecting what remains. Financial anxiety distorts time perception, making a temporary correction feel permanent. Panic rarely announces itself as panic. It disguises itself as logic. That is why it is so dangerous. Rule 1 is the liquidation freeze rule. The trap is selling long-term assets during a decline simply to stop emotional pain. It feels normal because taking action provides immediate relief. Moving money to cash stops the balance from changing, creating the illusion of control. But emotional comfort and financial wisdom are not the same thing. The fix is simple. No asset sales or structural portfolio changes are allowed within 72 hours of experiencing financial anxiety. This creates friction between panic and execution. Write a physical decree stating that your portfolio cannot be liquidated during emotional distress. Tape it to your desk or monitor. If panic strikes on Tuesday, you are prohibited from trading until Friday. Rule 2 is the continuous contribution rule. The trap is stopping investment contributions because you want to wait for certainty. Investors freeze contributions believing they are protecting cash from a falling market. This feels reasonable because buying declining assets appears reckless, but declining prices are actually discounts on the exact assets you already plan to own. The solution is maintaining automated contributions regardless of market conditions. Treat investing like a utility bill that must be paid every month without exception. Log into your retirement account and lock contributions onto autopilot. Remove the ability to manually approve or deny transfers. Let the system continue purchasing assets even when fear tells you to stop. Rule 3 is the screen time quarantine rule. The trap is obsessively checking balances and consuming endless financial news. Investors transform portfolios into entertainment apps, refreshing them constantly. It feels productive because information gathering seems responsible. In reality, repeated exposure to volatility simply feeds anxiety and increases the probability of making destructive decisions. Limit portfolio reviews to one scheduled check per month. Increase friction by removing investing apps from your home screen or deleting them entirely. Set a recurring calendar reminder for one specific day each month. Outside that window, refuse to open the accounts. The goal is not ignorance. The goal is preventing fear from dominating daily decisions. Rule 4 is the written investment thesis rule. The trap is abandoning a long-term strategy because a commentator, influencer, or expert predicts a worse crash. When your current plan is under stress, every alternative strategy appears safer. Investors jump from one asset class to another, trying to avoid temporary discomfort. Before owning any investment, write a simple thesis explaining why you own it and under what conditions you would sell it. Create a document called Investment Constitution. List every asset and its purpose. If the long-term thesis has not changed, then the portfolio remains untouched. Temporary market declines are irrelevant to a 20-year investment objective. Rule 5 is the inaction default rule. The trap is assuming every market crash requires immediate action. Investors believe staying still is weakness. Our culture glorifies constant activity and rewards visible effort. Doing nothing feels irresponsible. But in many financial situations, action creates more damage than inactivity. The solution is making strategic inaction the default response. During a panic, let automated systems continue operating without interruption. Close the dashboard, walk away from the screen. When breaking news announces a market decline, resist the urge to intervene. Often the most productive financial action is no action at all. Most people believe they have an income problem or an investment selection problem. They think predicting crashes or finding perfect assets will solve everything. But wealth preservation is neither an income problem nor a market problem. It is a system problem. Markets will always fluctuate. The objective is not eliminating fear. The objective is creating a system that functions correctly even when fear arrives. Market recoveries never feel comfortable. They begin when headlines remain negative and confidence remains low. The public rarely receives a clear signal announcing that the danger is over. Recovery often starts at the peak of pessimism. This means the correct investing decision usually feels wrong in the short term. Continuing contributions during declines feels painful, but that discomfort is often the price of future wealth. The investors who survive market panics are not superhuman. They simply anticipated fear and built systems before the crisis arrived. They accepted volatility as the mandatory price of admission for long-term wealth creation. Instead of renegotiating the rules during a downturn, they allowed the system to continue operating exactly as designed. This week, write your 72-hour liquidation freeze rule and place it where you will see it. This month, confirm that all investment contributions run on autopilot. This year, reduce portfolio reviews to 12 scheduled checks. Before the next market panic arrives, decide on one investing rule you will follow, regardless of the headlines. Share it in the comments. The best investing strategy is not the one that works when confidence is high. It is the one that still runs automatically when fear takes over.